The GTA housing market isn't just slowing down, it's undergoing a full blown correction. And RBC and TD, two of Canada's largest banks, are now sounding the alarm. Home sales are collapsing, household debt is skyrocketing, and economic cracks are starting to show. Hi, my name is Deloshan, and welcome to another episode of Real Estate Watch, where I provide you insights, breakdowns of current market trends, and keep you informed with the latest news on real estate and the economy. In today's video, we're unpacking everything from housing data and rising national debt to mortgage renewal challenges, construction slowdowns, and how the new tariffs are driving up building costs. So let's dive right in. The housing correction is here. Let's start with the latest numbers. Home sales in Ontario dropped 25% in April 2025, with the GTA down 33% year over year. RBC has called this one of the most intense housing corrections on record. TD is forecasting a further 15 to 20% price decline from the 2023 peak by the end of 2025. So this isn't just a soft landing, it's a full reset. And the pain is starting to spread across the financial system. And the debt levels are exploding. Canada's national debt has now surpassed $1.2 trillion, and household debt to income ratios are sitting at 185%, the highest among the G7. That means for every dollar Canadians earn, they owe nearly $2. And it's not just mortgages, it's credit cards, auto loans, and lines of credit. All are getting more expensive as interest rates remain high. And many families are renewing mortgages at double their previous rates. Seniors are spending through their pensions just to cover basic living costs. Banks are tightening up. Banks are no longer taking the same risk. RBC and TD are scaling back exposure to residential mortgages. Credit limits are being cut, some by $100,000 or more. New lending is drying up as risk models adjust. When banks, who profit from lending, start pulling back, it's a clear sign that the risk is no longer worth the reward. And the housing starts are also down. According to CMHC and Stats Canada, Ontario's seasonally adjusted annual rate of housing starts for May 2025 came in at 68,800 units, slightly up from April, but still down 20.7% year over year. In the GTA, only 1,225 new housing starts were recorded in March 2025. That's a 65% drop from last year. That's deeply concerning in a region that's supposed to absorb thousands of new residents each month. We're simply not building enough. And what about the falling prices and the current buyer's market that we're in? The average GTA home prices have fallen to $1.1 million, down more than 4% year over year. The sales to new listings ratio is sitting at just 30%, putting us firmly in a buyer's market territory. And there's tariffs and trade tensions that are adding more pressure. Adding fuel to the fire are growing concerns about the US-Canada tariffs, especially in the construction sector. The United States imports more aluminum from Canada than any other country. And any increase in tariffs raises costs not just for the Americans, but also for Canadian builders. So why does this all matter? Well, raw materials like H-beams, rebar, and steel often come from the United States. And if tariffs are introduced or even threatened, the cost of every high-rise could spike overnight. Builders are already facing delays. There's higher material costs, mean fewer projects, more financing challenges, and in some cases, canceled developments. So there's a crisis of confidence in the market. All of this is shaking up the confidence. The confidence is the cornerstone of any healthy market. And if investors and lenders begin to question Canada's financial stability, we could see rising bond yields, a weaker Canadian dollar, higher borrowing costs for everyone, from governments to homeowners, and the structural economic challenges that we have. RBC recently noted that Canada's economy, when adjusted for inflation and immigration, is now smaller than it was in 2019. So think about that. Despite record immigration and spending, we've gone backwards. And TD Bank also forecasts a 3.2% national price drop for the real estate this year, with steeper declines in major markets like Toronto. And in the condo market, they're projecting 15 to 20% drop from the peak by the end of this year. That's not all. We also have a spending problem. Despite all of this, the government spending remains elevated. New public sector jobs, infrastructure programs, and military investments are being announced, but without a clear plan to reduce debt. So we're now borrowing just to pay interest on existing debt. And if this continues, the burden will not fall on the policymakers, but on future generations. So what's my thoughts on this? Well, RBC and TD are no longer forecasting. They're adjusting. They're protecting themselves. And the data is very clear. Home sales are collapsing. The debt is unsustainable. Construction is stalling, and consumer confidence is fading. So this is not a blip. It's a structural reset, and it's not just about economics anymore. It's a generational risk. So the next time someone tells you that everything is fine, ask them, what numbers are they looking at? Because the ones that we're seeing are flashing red. Thanks for watching. If you found this video helpful, please like, subscribe, and hit the notification bell so that you don't miss any future updates on the GTA housing market and the economy. Stay informed, stay prepared, and I'll see you in the next video.